Have you ever wondered how to make money from the Forex market? Welcome to the fascinating world of Forex trading, an arena that never sleeps, operating round the clock every day of the year. This market, my friends, is the foreign exchange market, abbreviated as Forex. It is here that currencies are traded, and it's the largest financial market in the world, dwarfing even the stock market. Its importance in the global economy is unparalleled, with trillions of dollars changing hands every day. From central banks and hedge funds to small-time investors, everyone is a part of this colossal money-moving machine. The Forex market provides a platform for buying, selling, exchanging, and speculating on currencies, and it's this activity that creates the opportunity for you to make money. So, are you ready to dive into the world of Forex trading and discover the secrets to making money? To navigate the Forex market, you first need to understand currency pairs. Now let's dive into this crucial component of Forex trading. A currency pair is simply a quotation of two different currencies. The value of one currency is a ratio of the value of another. The first listed currency is called the base currency, while the second is the quote currency. Think of it as a teeter-totter. On one side you have the base currency and on the other the quote currency. When you trade, you're essentially predicting which side will rise and which will fall. In a currency pair, the base currency is the one you are buying or selling against the quote currency. For instance, if you see a currency pair like EUR-USD, the EUR is the base currency and the USD is the quote currency. It simply means you're trading euros against US dollars. The value of the base currency is always 1. So if the EUR-USD pair is trading at 1.15, it means that 1 euro is worth 1.15 US dollars. If the value of the base currency rises or falls, it will affect the value of the quote currency in relation to it. Now, it's important to note that not all currency pairs are created equal. There are major pairs which include the most traded currencies like the US dollar, euro, Japanese yen, British pound, Australian dollar, Canadian dollar, and Swiss franc. These pairs make up about 80% of global Forex trading. Then there are minor pairs which usually include the major currencies against each other, excluding the US dollar. And lastly, there are exotic pairs, which are made up of a major currency paired with the currency of a developing economy, like South Africa or Mexico. Remember, each pair has its unique characteristics and behaves differently under market conditions. So, it's crucial to familiarize yourself with the pairs you plan to trade. Understanding currency pairs is the first step in your journey to making money in the Forex market. Now that you understand currency pairs, let's examine how to analyze the Forex market. To make informed decisions in the Forex market, two principal types of analysis come into play: fundamental and technical analysis. Both are vital for a well-rounded market perspective. Let's start with fundamental analysis. This approach involves examining economic indicators, such as a country's gross domestic product, inflation rates, and employment figures. These indicators provide insight into a country's economic health and, subsequently, the potential strength or weakness of its currency. For instance, a robust economy usually bolsters its currency's value, making it an attractive buy for Forex traders. On the other hand, technical analysis focuses on the study of price movements. This type of analysis utilizes chart patterns and technical indicators to predict future price trends. For example, if a currency pair's price has been consistently rising above its moving average, it might signal a bullish trend, suggesting it could be a good time to buy. But here's the catch. While each type of analysis provides valuable insights, neither is foolproof. They are tools in your trading toolbox, not crystal balls. That's why it's crucial to use them in tandem, providing a more holistic view of the market. Now, let's discuss the importance of a disciplined approach to market analysis. Making decisions based on gut feelings or hunches can lead to disastrous results. Instead, successful traders maintain a disciplined approach, consistently applying their analysis methods, sticking to their trading plans, and carefully managing their risks. Remember, the Forex market is a vast, complex entity, constantly influenced by countless factors. Therefore, it's essential to stay informed, continually learn, and adapt your strategies as market conditions evolve. With a strong foundation in market analysis, you're well on your way to making informed trading decisions. Making money in the Forex market isn't just about choosing the right trades, it's also about managing your risks. Let's delve into the principles of risk management in Forex trading. One of the most crucial risk management strategies is setting stop-loss orders. This essentially means predetermining the maximum amount you're willing to lose on a trade. If the market moves against your prediction, the trade will automatically close once it hits your set stop-loss level. This way, you prevent further losses and protect your trading capital. Another key principle is to not risk more than a certain percentage of your trading account on a single trade. Many seasoned traders follow the rule of thumb of not risking more than 1 to 2% of their account balance. By doing this, you ensure that even if you have a string of losing trades, you still have enough capital to keep trading and potentially recover your losses. Having a risk-to-reward ratio is also an important part of risk management. This ratio measures the potential profit of a trade against the potential loss. A good risk-to-reward ratio to aim for is at least 1 to 3. This means that for every dollar risked, you're aiming to make $3 in return. Beyond these principles, it's vital to have a risk management plan. This plan should outline your risk tolerance, your stop loss and take profit levels, as well as your risk-to-reward ratio. It should also include a contingency plan for different market scenarios. Having such a plan will not only help you manage your risks, but also enable you to trade with discipline and consistency. Risk management isn't just about protecting your capital. It's about making strategic decisions that allow you to stay in the game for the long haul. It's about understanding that Forex trading isn't a get-rich-quick scheme, but a journey that requires patience, discipline, and strategic planning. Remember, successful Forex trading is as much about managing losses as it is about securing wins. A solid trading plan is the roadmap to success in the Forex market. This statement isn't just a catchy phrase, it's a fundamental truth that every trader should engrave in their minds. Consider this. You wouldn't set off on a journey without a map or a GPS, would you? The same applies to Forex trading. Without a solid plan, you're essentially navigating in the dark, and the chances of getting lost are high. So what exactly is a trading plan? Think of it as your personal guidebook. It outlines your financial goals, spells out your trading strategies, and sets your risk tolerance levels. It's a comprehensive document that lays the groundwork for every trading decision you'll make. One of the key elements of a trading plan is your entry and exit strategies. These are the rules you set for when to buy and sell your currency pairs. Your entry strategy could be based on various factors such as a specific price point or a particular economic event. Similarly, your exit strategy might be a predetermined profit target or a stop-loss order to limit potential losses. Risk management is another vital component of your trading plan. Forex trading is inherently risky, and it's crucial to have measures in place to protect your capital. This could involve diversifying your portfolio, setting stop-loss orders, or only risking a small percentage of your capital per trade. Finally, your trading plan should include a review process. This is where you regularly assess your trading performance and make necessary adjustments. The Forex market is dynamic and constantly changing, and your trading plan should be flexible enough to adapt to these changes. Remember, a trading plan is not a guarantee of success, but it does increase your chances significantly. It provides structure, instills discipline, and reduces the impact of emotions on your trading decisions. With a well-crafted trading plan, you're ready to navigate the ups and downs of the Forex market. So gear up, prepare your plan, and embark on your Forex trading journey with confidence and clarity. So, we've covered a lot of ground today. We started our journey by introducing you to the dynamic world of Forex trading. We moved on to the importance of understanding currency pairs and how they form the basis of any Forex trade. We then delved into the art of analyzing the Forex market. We explored how to interpret market trends and understand economic indicators, which are crucial to making informed trading decisions. Next, we discussed risk management in Forex trading. We emphasized the importance of setting stop-loss orders and limiting your exposure to prevent devastating losses. We concluded our discussion with the building of a robust Forex trading plan. We highlighted the need for a clear strategy, including entry and exit points, to maximize profits and minimize losses. Remember, success in the Forex market isn't achieved overnight. It takes patience, discipline, and continuous learning. But with these tools